over the last few years, the amount of tax that you pay in a limited company has increased, and the amount of tax you pay as a sole trader has decreased. And that has changed the balance between them. So this video is a bit of a deep dive into whether you're better off still having a limited company, or in fact, you're better having a sole trade. And when I say sole trade, partnerships, limited liability partnerships are taxed in the same way as a sole trade. I do regular updates on tax and accounting, so if you'd like to be kept up to date, then please subscribe to the channel. If you press the like button, it helps me and the channel, so thank you for doing that. So a limited liability company. So first of all, let's look at the legal side of it. You get limited liability if you have a limited liability company. So you are protected from your creditors if something goes wrong. And that might be really important to you. And that overwhelms anything that I talk about in terms of tax. Now, you can have a limited liability partnership, which is like a hybrid between a partnership and a company, which does give you some protection against your creditors, but not against the tax on the profits, because that is always personal, because the tax on partnerships is like sole traders. It's taxed on the partners as it would be on the sole trader, and it's taxed at the same rates as it would be if you're a sole trader. So the limited liability might be important. And also, if you are in a partnership, including a limited liability partnership, you do need two people. It can't be a partnership of one, including the name. And so that can be important, because if it is just you in the business, you can't get limited liability within a partnership. So now let's look at the tax. Now, the tax of sole traders and partnerships is actually more simple. So I'll do that first. The first 12,570 is not taxed. It's really basically not taxed in any circumstances. There might be a little bit, but basically the first £1,000 or so a month is not taxed. Then you pay basic rate tax, and then you pay higher rate tax. And if you go over 100,000, you lose your personal allowances. So most people that we deal with don't go over the 100,000. So as a basic rate taxpayer now in the new tax year, so that's from April 2024, you will pay 20% tax plus 6% national insurance. So that's 26% as a basic rate taxpayer, and 40% plus 2% national insurance, 42% as a higher rate taxpayer. So it's relatively simple. If you're an employee, incidentally, you pay 20% tax, and it's going to be 8% national insurance. So that's 28%, but your employer pays 13.8%, so that's a little over 40% taxpayer as a basic rate, and over 50% if you're a higher rate, which is why people don't like to receive salaries. But I do need to talk to you about that a little bit later, because sometimes you don't pay employers national insurance, or indeed employees if you're over the retirement age. Getting back to companies. Now, companies, it's become more complicated. And the difference in tax has happened because national insurance for employees has gone down by 4%, for self-employed by 3% over the last 4 months. But over the last few years, corporation tax, which is the tax that companies pay, has gone up, and dividend tax, which you pay when you take money out of the company, has also gone up. In a company, there are now 3 tax rates, which is why it gets a little bit complicated. So if your profits are less than 50,000, the tax rate is 19%. If they're between 50,000 and $250,000, you pay a marginal rate, which is 26.5%. And then if your profits are over $250,000, you pay 25% on all the profits. And that's how it works. So there's 3 rates, which is why it's sort of confusing, because then you've got to think about it on each of those rates. And it's slightly more complicated than that. So you can't get away with it by having 2 companies. So if there's more than one company that's co-owned, then that 50,000 and $250,000 limit is divided by the number of companies that are co-owned. So if you had 5 companies, the 50,000 would turn into 10,000 for each company, and the $250,000 would turn into 50,000 for each company. So you can see how you can very easily get into the marginal rates of 26.5% or the top rate of 20%. So on top of that, so the company pays that, that's company liability, and the company pays that tax. And then the owner, the shareholder, then pays as a basic rate taxpayer, normally pay a salary of 12,570, so you don't pay any tax on that. Any money that you take out, you pay dividend tax, you pay it at 8.75%, and at a higher rate, you pay it at 33.75%. What does that all come out at? Because with dividend tax, it's on the money that's left after they've taken that first 19 or 25%. So you can't just add up the percentages and get to the effective tax rate. And it's the effective tax rate that, of course, people want to know. So as a basic rate taxpayer on the lowest 19%, you're going to be paying 26.1%, which is 0.1% higher than a self-employed person. So it's basically the same. If you are paying the marginal rate, so if you're paying the 26.5%, then that is 32%. So you might not want to have a company if you're paying the marginal rate. If you're paying, and then at the higher rate, so if you're a higher rate taxpayer over 50,000, then you're almost certainly going to be paying 26.5% corporation tax because your profits are likely to be over 50,000. So the overall tax rate is just over 50%. So it's quite a lot higher than if you're self-employed, where the tax rate is 42%. So is that easy then? Do you just become self-employed? Well, no, hold your horses. It's more complicated than that. Because if you are retaining profits in the business, then if you've got a partnership or a sole trader, you pay higher rate tax on all those profits, regardless of whether you take them out of the business. Whereas if you've got a company, you pay the corporation tax, but you only pay the higher rates of tax if you take the money out of the company. Now, if you're building up reserves, if you're growing your business, you're building up, so you've got more debtors, you've got more assets, then you want to retain some of those profits, you've got more stock, and the cash isn't available to pay the tax. So it's really hard to retain profits if the taxman's taking 40% of the profits and the cash that the business is generated. So if you're having retained profits, you're quite likely to want to be in a limited company. And if there's a husband and wife team can both take out 50,000 before you pay higher rate tax, that's £8,000 a month, then that's actually enough for most people, so they don't end up paying higher rate tax. So the higher rate tax issue in a partnership or a sole trade is a problem which is alleviated by it being in a company. So that can be quite a big and important thing. The other thing is the treatment of cars. So cars are really important because they're such a big expense. If you're in a limited company and you have an ordinary car, you won't want it in the company because the benefit in kind tax is horrible. I mean, you can do the calculations, but generally it's horrible. If you've got a pickup truck or an electric car, then the tax isn't too bad, and actually you might be better off having your car in a limited company. Whereas for a normal car in a partnership or a sole trader, often it's better because the way that the tax works is you take the costs of the car and the percentage that's used for business you use as a business expense, and that's normally better than having a normal car in a limited company where you've got this horrible benefit in kind problem. So I just want to have a look then a little bit at salaries. In limited companies, we've always traditionally we paid £1,000 a month to our directors. That's more or less tax free, and that works great. £1,000 we can get in our heads and understand. Now that's not necessarily the case because there is something called the employment allowance. So the first if there's two of you in a small company, then you get a £5,000 employment allowance, which means that you don't pay the employer's national insurance on the first £5,000 of employer's national insurance. So you don't have any spare national insurance if, like me, you've got lots of employees, or if there's one person in the company, then it doesn't work, or if you're a large company. But for some people, they've got this employment allowance and they're not using it. In that case, you could be better off if you're paying tax in the company with dividends and the 26.5% company tax. If you're paying tax at 32%, you might only be paying 28%, 20% tax plus 8% national insurance and no employer's national insurance if you've got spare employer's allowance. So you might be better off having a salary of £20,000 a year, and that will save you a little bit of tax. I mean, we're talking about £400 a year, maybe a little bit more. But, you know, if there's two of you, £1,000, you know, I'd rather you had it than taxman. So there are also other advantages of having a salary, in that you pay your tax monthly, which most people would prefer, and when you fill out a credit card form, you can put a salary down, which is just a little bit helpful, and heaven forbid they ever furlough us again. But if that is the case, then definitely you would have wanted to have a higher salary. So that's something we're going to look at for our clients. I will send this out to my clients so that you've got a long sort of analysis of everything I've said. But if you want to go through this with me, I'm very happy to do that, and I'm happy to do that for our clients. Or if you're watching this and you want to understand what is the best way in which you should be structured, then I'm also happy to do that. So with no further ado, that is the new way in which we pay each other. Now it sounds very complicated. The reason that it's complicated is because it's a bit more nuanced. It doesn't matter as much as it used to. Because it doesn't matter as much, it's like, should we be limited or should we sole trade? It's much more nuanced, which is much more complicated, but also means it doesn't matter. So hey ho, it's sort of good. So if you'd like to be kept up to date with other issues on tax and accounting, then please subscribe to the channel, and if you press the like button, it helps me and the channel, so thank you for that.